Thank you everyone for being here with us for our active single family versus passive multifamily presentation. I'm really excited to have all of you guys here on Thursday night, and I hope everyone can take some few great nuggets that can actually help to create more wealth for your family. A few ground rules before we get started. If you have any questions, please send us the questions in the chat box below, and so that way, if somebody else has the same question, we can answer it at the same time. And for whatever reason, if we cannot get to your question, we will reach out to you personally. Or if you forgot, or if you didn't have a chance to enter the question in the chat, you can always reach us. We'll actually put our contacts at the end of the presentation. So without further ado, I'll go ahead and get started with a brief background on Pecos Capital. Pecos Capital is a private equity firm focused in investing in value-add B and C class multifamily assets. We currently have about $15 million in assets under ownership, comprising of 220 doors. In fact, the pictures that you see on the screen are all the assets that we own. We personally own these assets, which has helped us to solidify our investment thesis. And now we're looking to raise capital to bring our investors the same exceptional returns we have achieved through our personal real estate investments. So now we'll go through introduction, but before we go through the introduction, let me just walk you through the agenda that Mike's gonna host. So first we'll go through the introduction. Next, he's gonna walk us through the purpose of this presentation and why Mike got into real estate, single family versus multifamily, and what is a typical single family investment like, and some of the negatives that most of you guys have been through. And he's going to talk about the returns of single family and multifamily comparison. And at the end, he's going to talk about a bonus thing that was in the email. If you don't have a lot of money, how do you get started in real estate? So that's the bonus that he's going to talk about. So we will briefly introduce ourselves, and then we will get started from there. So I'll start. My name is Malai. I'm one of the managing partners in Pecos Capital. I started my real estate journey in 2004 and have experience in multifamily as GP and LP. And I've invested in single family homes, hard money lending, and I've also done mortgage notes. In multifamily, I have invested in 6 deals as a LP, and that's about 1,000 doors in total. I'll turn it over to Mike.
Yeah, thank you, Malai. So my name is Mike Prahl. I'm responsible for deal sourcing, underwriting, and investor relations at Pecos Capital. I have over 9 years of real estate experience, including professional roles in banking, debt and equity investing, asset management, and property management. And then while I was working professionally in real estate, I've also been an active multifamily investor for the past 6 years and passively for the past 9. So I've got a good background in real estate, both actively on the investing side and professionally on the debt and equity side. And I did achieve my bachelor's degree in real estate and finance from Florida State University back in 2014. So with that, I'll let Mahesh take over and give a brief introduction for himself.
Thanks, Mike. Hello, everyone. Welcome to our webinar. I'm glad to have you all here on a Thursday evening. I'm Mahesh. Krishnaswamy, one of the managing partners of Pecos Capital. I started my real estate journey back in 2003. As far as multifamily, I invested in few properties as a general partner. Thank you. Back to you, Mike.
Yeah, thanks, Mahesh. So as a quick disclaimer, Pecos Capital, we actually as a principal and not in any other capacity, unless we explicitly state or agree to it. We definitely think you should go ahead and discuss the information contained in this webinar and run it by your own financial, legal, accounting, tax, and any other advisors as applicable. And then once again, remember that do not invest your money only on our recommendation alone, and please remember laws and regulations change all the time, so be sure to do your own research on the material we present in this slide. Okay, so quickly wanted to go through the purpose of this presentation. So as you know, it's single family homes, active investing versus passive multifamily investing, but we have a couple bullet points we'd like to hit on. So we want to first of all explain the different ways to invest $100,000 in residential real estate. And we also want to go through why we think multifamily properties are more predictable, more stable, and more profitable than single-family house investing. We're going to go through a real case study of a single-family home investment, and then go through a passive multifamily investment that we've explained in previous webinars. And then we also want to show how multifamily can be completely hands-off and still provide efficient and high returns that can only be achieved through multifamily investing. And finally, as a bonus, as Malai mentioned earlier, we want to show you how to invest in real estate, even if you don't have $100,000 lying around, or even $50,000, which is the minimum that Pecos Capital accepts as a limited partner investment. So even if you have less than $20,000, you maybe have enough just to purchase or put a down payment on a single family home. We show you how you can get involved in real estate and really take advantage of all the benefits that real estate has to offer. All right, so why did I get into real estate? So as I mentioned, my background began right after I graduated college. I got a job working for a commercial mortgage-backed security firm. So I was an analyst looking at a bunch of different real estate deals across all different facets of commercial real estate. And I saw all the different opportunity that was out there, right? I saw the tax advantages through depreciation. Some of the investors could shield some of the income from taxes. So it was a very efficient from a tax standpoint. I saw the leverage. They would use other people's money, borrow at a low interest rate, and then be able to grow their wealth through that leverage. I saw that there was, they were achieving a pretty great amount of cash flow. We would underwrite to make sure that the cash flow from the property, is there to support the debt service. And so, there's always cash flow on top. And so I wanted to take part of that cash flow. And then, of course, the big one is appreciation. I wanted to, as time goes on, typically real estate will go up in value, not in a linear line, of course, but it will typically go up in value as the years go on. And so I wanted to take part in that appreciation. So I saw this, all these, great things about real estate at my job and wanted to just figure out how to take advantage of them. So I started investing in single family homes. So I want to briefly, for the purpose of this webinar, I want to explain what single family homes are. So single family homes are single family homes, of course, one unit, duplexes, 2 units, triplexes, fourplexes, 3 or 4 units. They're all typically under one roof, and they're located in residentially zoned neighborhoods. They're typically sold by residential brokers, and their value is based on sales comps of similar properties in the area. They're also financed by lenders based on the borrower's income with restrictions on the number of loans. And then finally, they're managed by either the owner if they live in the same city or really close by in the same city, or a professional company. Compare that to multifamily. Multifamily is 5 or more units, typically in buildings of 4 or more units, but often it's 8 or more if it's in a garden style apartment complex, or it could be up to 20, 30, 100, depending on if it's a mid-rise, high-rise building, etc. They're typically sold by commercial brokers or off-market directly from the seller to the buyer. The value is based on a multiple of the historical income stream, or is what we call a cap rate. So the value is directly related to the amount of revenue that the building produces. They're typically financed by banks and other lending institutions based on the value and income of the property. So they'll have a value, they'll have a certain amount of leverage based on the value of the property, and they'll make sure that the income of the property covers that property. It's not based on the actual borrower of the money. It's based on the property. So they make sure that the property supports the loan. And then finally, it's managed by a professional company. It's not very often that it's managed by the actual owner itself. Okay, so now you have an understanding of what we're talking about when we talk about single family. So let's look at, let's talk about a typical single family investment. So you may find a property on market and you buy the property, like I said, either through a broker or possibly off market if you have a friend that you know that's selling the property. Next, you rent out the property to a resident that pays rent, which will typically or hopefully cover expenses, it'll cover the mortgage, and provide a little bit of cash flow over the time. And either you'll manage the property, or the property manager you hire will manage the property. And when maintenance issues come up, they'll take care of it or collect the payments, the rent payments. And then finally, in the future, you'll sell the property based on how comps in the area have appreciated. And hopefully you'll sell it for more than you purchased it for, which will generate a large portion of your return from a single family investment. So now I'll go to the negatives of single family homes versus from what I've experienced in multifamily homes. So as I mentioned, I got into single family homes because I saw all the opportunities of single family homes when I was working for a real estate company, or I saw all the opportunities of real estate, but I needed to access it. And I thought the best way to do that was through single family homes, lower dollar amounts, more achievable, especially just out of college. So I got into it. But here are kind of some negatives that I learned about single family houses once I got into them. And some of those may ring well with you as well. So the first is the property financing is based on your income, which can end up limiting the number of houses you can buy. So even if you've got a great investment, let's say it's 2-unit duplex, and it generates a ton of income and it will easily cover the debt service, they're gonna make sure that you and your W-2 job or whatever income you show on your tax return covers the financing or covers the debt service on that. So it's not just based on the property. In addition to that, lenders set a cap typically of how many loans. So if you have, Freddie and Fannie Mae loans, you'll typically only get between 6 to 10 loans. And so after you've maxed out that loans, you can't continue to grow and scale because they won't continue to lend to you. So you have to turn to other really expensive forms of financing, maybe like a hard money lender or some other form. In addition, those loans that you get will almost always be recourse, which means if something goes bad, you lose your W-2 and big expenses pile up, there is always the potential of you losing your home and having further downside risk because they're fully recourse to you, which means they can go after all your personal assets to recover any losses on the mortgage that the bank experiences. Next, commissions and closing costs are a really large percentage of the sale. So typically in single family homes, you'll see 6% commissions on a sale, which is paid for by the seller. So you'll see the buying agent gets 3, the selling agent gets 3. And then on top of that, there's usually closing costs, which can be another 1 or 2%. So you're looking at almost 7 to 8% of closing costs and commissions. So you have to have a good amount of appreciation or it can completely offset any gains that you've made. And the value can be offset by these expenses. And then overall expenses for the property when you're renting them out are just less predictable and they really deeply impact cash flow because there's just not as much cash flow coming from a single family home versus a multi-family home. Another negative is property management is more expensive. It's offsite and it's split between many other properties. From my experience, property management is between 8 to 10% of your gross revenue each month. And so that's a pretty large amount of your revenue to just be taken off the top. And in addition to that, they often don't go by the property that often. They may go by once or twice a month, if that. And if they don't get any service calls, they may not go even once a month. And then it's also split between many other properties because they have other properties that they're managing. They're going to be focusing on the ones that need their attention. So they're not really going to be focused on your property as much unless there's something major occurring. Next is vacancy is more expensive and cuts into cash flow significantly. So this is kind of goes back to what I was saying earlier, where if you have one tenant leave, not only on it, like let's say it's a duplex, you have one tenant leave, well, there goes approximately 50% of your revenue. And not only that, then you have to pay your property manager what's typically a 1 month leasing fee or 1 month rent fee to backfill that space. So even if they do a really good job, get it cleaned up, get it rented out within 30 days of when the old tenant moved out, you're still going to be losing not only that month's rent, but then you're also going to be paying the next month's rent to the property manager. So you effectively have 2 months loss of income just when one tenant moves out. So it really deeply impacts your cash flow. Legal costs can also take a larger percentage of the cash flow. If you want to put your property in an LLC to take advantage of, the legal opportunities that come from being in an LLC or the legal protections, You know, in Florida, for example, it can be $135 every year to register an LLC, which if you're only making or grossing a couple $100s a month, that's a fairly significant portion of your cash flow that you're paying just to keep yourself protected from a legal standpoint. Next, it's just less cash flow in general. As you can see from several of these bullet points, that the fact that there's not a ton of cash flow in general means the profit margins are thinner. So any random expenses that can occur will impact your cash flow more, and you may even have to come out of pocket at certain points to pay for expenses that pop up. Also, because there's only 1 to maybe 4 units max, there's less economies of scale. So the roofs that cover your single family duplex, it's only covering 1 or maybe 2, 3 units. Whereas if you're looking at multifamily, it's covering multiple units. So if a roof goes out, it's covered by a lot more of the income. In addition, in multifamily, water heaters can often be shared. Various other things can be shared. So in general, there's more economies of scale with multifamily when you compare it to single family homes. And then finally, this is a really big one, especially if you're really in the weeds and trying to operate these properties as efficiently as possible. The appreciation of the property is based on the market and not on the income. So let's say you're reducing expenses well, you're keeping income up, there's not a lot of turnover, you've got a rock star property manager, you're keeping your place vacant or occupied all the time, not a lot of vacancy. It's going to matter from a cash flow standpoint, but it's not going to impact the sale. Whereas in multifamily, if you do a great job operating the property, the value is based on the income it generates, so it will sell for more in the future. So these are the main negatives of single family houses that I experienced when investing in them. And so now I want to take you into an example to really kind of show you just in the numbers how this all plays out. So let me move over to my model and we will go through that now. So here you can see a duplex example. So I'm going to take out all of the expenses that you'll typically see and show you what this investment might look like on paper. So it's a duplex, 2 units. The sale price is $400,000. So there's going to be a down payment of $100,000. 2 units each are renting out for $1,500 for a total gross revenue of $3,000 per month. So right now, the way this model is built, it's assuming there's no vacancy, there's no leasing fees, no other miscellaneous expense. All we're keeping is basically your fixed expenses, which are the management, which is a percentage of revenue, insurance, taxes, and then yard maintenance to keep the lawn. And so as you'll see, this actually looks like a really attractive investment on the surface, right? You've got cash flow of 6.4%. Your IRR is 15.25%. And so those are pretty good numbers. I mean, I would definitely be pretty happy with the 15% IRR. But in reality, this isn't how the property is going to play out, right? There's going to be tenants coming and going. Maybe for this example, we're assuming a tenant's going to leave every other year. So if you have 2 tenants, one's going to be leaving each year. So let's add that to the model. So we're assuming 6.2% of vacancy, which equates to 1.5 months of vacancy, a total of 24 units. So because there's 2 units, there's 24 months of total potential vacancy. So it assumes 1.5 months. So basically one person or one tenant moves out, and it takes a month and a half to get a new tenant in for the next lease. So already that impacts us. As you can see before, it was 6.4% average cash on cash. Now it's down to 4.24%. So it even just, one tenant moving out a year impacts your cash flow pretty substantially. So not only that, but like I mentioned before, you're going to have to pay a leasing fee. So if we pay 1 month leasing fee, that further reduces our average cash on cash. So, when a resident moves out, there's usually some sort of turnover expenses that come up: carpet, painting, plumbing, you name it, there's something to do. So let's average that out to maybe $1,000, which means maybe one of the rooms needs new carpet and some touch-up painting. So as you can see, all these little expenses start to really add up and impact your average cash on cash. And so if you're holding a property for 5 years, you might see, well, an AC, you've got 2 different AC units. They typically last about 10 years each. So over the term of 5 years, at some point, you're going to need a new AC. So let's project a new AC that needs to be put in year 3. All of a sudden, your average cash on cash is 0.81%. Your IRR is down to 10.61%. So there's really not a lot of room. And in year 3, you're even losing money. So just to finalize kind of general assumptions that I would make, you're probably going to have another $800 of random expenses in the year. This isn't even accounting for potential LLC costs that we described earlier. Potentially someone could move out more often. Random other maintenance expenses could occur. So as you can see, our cash flow is on average slightly negative. In reality, this is basically breaking even, and our IRR is 9.91%. And all this is basically based on the appreciation of the property. So you're breaking even on the cash flow, but you're making money still. And in fact, 9.91%, that's not bad, right? That's better than the stock market is on average. So not terrible, but still not crazy. And you're really not seeing a ton of cash flow from this example. So to give you a point of comparison, this is what, a single family active investment might look like, where you find the property, you hire the property management company, you oversee them, make sure they're performing, following up with them, etc. So let's switch this over. Let's compare it to a multifamily example. So here's an example of a property that we have seen in the past, right? So we've got everything budgeted out for on the multifamily property because it's really truly operated like a business. So you've got your total gross revenue, you've got vacancy accounted for, you've got loss to lease, bad debt, tenants, not paying based on their lease terms. You've got advertising expenses, contract services, general administrative, utilities, taxes, insurance, you name it, right? It's there, it's all accounted for. Even the big ticket items like a roof, right? Like we're accounting for that with a replacement reserve. We're accounting for turnover from tenants. We're accounting for repairs and maintenance. So all these things are accounted for on a multifamily property when you're investing as a limited partner. So let's go back to the slide and compare what these two multifamily investments, or the multifamily investment versus the single family home, and how they might compare. So single family home versus multifamily limited partner returns. So we went through this example here where we have $100,000 investment from a single family home. Year 1, you're basically breaking even. Year 2, you're starting to make some money. Year 3, you're starting to make some more money. In year 4, you're also still making money. It's slowly growing, slowly going, depending on the expenses that pop up in a given year. However, and then in year 5, that's when you get the largest return, right? So your average cash on cash is basically breaking even. Your IRR is 9.91%. And that's mostly based on the sale because the property is continuing to appreciate, even though there's not a ton of cash flow, it is continuing to appreciate. The multifamily example is very similar. It's another $100,000 investment. However, you're seeing consistent cash flow from year 1 through year 5. So $7,400 in year 1, it dips slightly in year 2 to $6,500 because of the interest-only period that you'll typically see in a multifamily property. Then it starts to climb back up in year 3, climbs back up in year 4, and then you sell the property for a pretty similar amount of gain as you do for the multifamily. The single family. The big difference, of course, is you've got 7% average cash on cash versus the single family investment where you're basically breaking even. But as you can see, because of that cash on cash return that you're getting from the multifamily, your IRR is significantly boosted. Your average annual return is significantly boosted. In fact, from the single family home, you're getting less than 2/3 of the return that you get from a multifamily investment. So as you can see, based on a $100,000 investment, there's a lot of opportunity in the multifamily. And not only is it, are you investing in a multifamily property versus single family and giving you that stability, that cash flow, and a better return, but it's also, this example shows you a completely passive investment. So it means you're basically giving your money to a general partner to invest in a multifamily property for you, and you're not having to do any of the day-to-day, oversee the manager, make sure that they're doing their job, worrying about, rents and leases being executed and rents being paid and, units being rented, et cetera, right? All you're thinking about is just collecting the cash in the bank once a month, once a quarter, depending on the distribution cycle. So as you can see, this is a great opportunity if you have $100,000 or $50,000. But not everyone, of course, has $100,000. Not everyone has $50,000. And so, if you are in, you do want to get into real estate, but you don't have that kind of money, there is another alternative that I really want to share with everyone, because I think it's a really powerful way to get started. I know it's a way that I got started, and I've actually done it on a couple different properties. And I'm going to show you an example of one of the properties that I house hacked. So I will go back to my model here and bring up my house hacking model. So it's very similar to the single family model that I showed you earlier. The main difference is this one is, like I said, is one that I've house hacked. It's a triplex, so 3 units on one property. The purchase price is $320,000. The amount of equity is $16,000. So it's, a fairly typical down payment for a single family home. But, you can invest in, rental real estate with that same down payment. So when you're investing in a single family home, duplex, triplex, fourplex, and you're house hacking, you actually can qualify for an owner occupied loan, which means you get really attractive terms. So the interest rates are better. I'm projecting a 3% interest rate on this deal. Not only that, but because you live at the property, you can get rid of the management fee expenses that you pay to your property managers. You can get rid of the leasing fees because it's right there behind you. You can just post on Craigslist, post it on Zillow, and lease it out to prospective resident. Your insurance even right here is actually lower. I know when I was house hacking a fourplex, for example, my initial, when I was living there, was my insurance expense was $1,200. When I moved out, it actually jumped up to, I think, $2,400. So it was a huge difference in insurance expenses. Taxes will basically remain the same. I'll assume you're not doing the yard work. You're not doing, the general drywall repairs, painting, any miscellaneous expenses that might come up. You're certainly not replacing any AC units. But you are assuming that of the 3 units, you're renting 2 of them out, one for $850, one for $950. And so the way to think about house hacking is, even if you're not making cash flow just by living there, you might still be breaking out better than break even, right? So in this example, we're assuming, you're renting out 2 of the units and you're living in the 3rd. You don't have a roommate. If you had a roommate, you could even boost, this could even get even better. And I'll show you that in a minute. But for this example, let's assume you're leasing out the 2 units and you're living in 1 unit. And so your net cash flow, at the end of the day, you pay $4,000 for your mortgage, because that's not what's being covered. After all your expenses and everything, you still have to pay $4,000 over the full year. But however, a mortgage is made up of principal and interest payments. So interest payments is what you pay to the bank for providing you the loan. The principal is how you pay down the loan. So even though you're paying some part of it interest and some part of it principal, not all of it is interest. So for example, in this scenario, year 1, while you're paying the bank $4,000, $6,000 of your total payment to the bank is actually principal paid down. So in reality, your real profit is over $2,000. As you can see this play out in year 2, it's $2,700. Year 3, you have that big AC expense. So you're losing a little bit of money in real terms, but then by year 4 again, you're back up into the positive. So it's a really powerful way to gain equity in a property and effectively live for free, or even make a little bit of money each year just by living in the property. As you can see, the total IRR is 20%, which is higher than both the multifamily and the single family investment. And let's say, it's a 2-bedroom you're living in, and maybe you can even get a roommate, charge them $450 a month. Well, this just gets even better. Now at this point, your real profit is $7,200, $7,900. Even with that AC expense, you're still more than breaking even. Your IRR is almost 40%. It looks great. And so this is just a really attractive and something I highly recommend to anyone that is trying to take advantage of real estate, doesn't have $50,000, $100,000 to invest, doesn't have a ton of money, but at the same time, you can still make a ton of money or, offset your mortgage. So even if you don't have that roommate, just wanted to show you, if you invest $16,000, put in your down payment in year 5 when you sell, based on a simple 3% appreciation rate. When you sell in year 5, you can expect net like $71,000. So there's just a ton of opportunity here. So I wanted to definitely share that. You don't have to be doing big deals and doing all that to really take advantage of the power of real estate. So just think that's a really great opportunity to show. And if you have any questions about it, if there's anything in the chat box, feel free to put it in there, and let's open it up for questions now.
Malai, you're on mute.
I'm sorry. Mike, before we open up for questions, we have a few questions, but we're actually running past the time. We're going to reach out to all of these, all of you guys who had questions after the meeting.
I had a question. So in thinking about house hacking, your example was with a triplex. So is that a way to optimize it, or how does that play out with having different numbers of units?
Yeah, I mean, I would say, I think the more units, the better when you're looking at house hacking. In our example, it was a triplex, but if you had 4 units, usually, the more units, the more revenue relative to the purchase price. So typically the best way to offset your income as much as possible is to, try to buy a 4-plex if you can. But even a duplex or triplex, if that's what's in your market, if you can find a really good deal, it still makes a ton of sense. So I think, even a single family home, if you can buy a 4-bedroom house, rent out 2 or 3 of the other bedrooms, you can often offset a lot of your, or maybe even all of your mortgage that way. So there's a ton of creative ways to do it. I mean, there's a ton of stories of people, renting out, having actual roommates in the room. So there's just a ton of ways to do it. And there's a lot of just powerful ways to get involved in real estate.
That's a great point, Mike. Thank you so much, Mike. I think I actually picked up a few nuggets myself. This is amazing that, you don't really need that much money to get started. If you have a will, there is a way. You can always figure out ways to house hack and build your wealth. Again, thank you all for attending. If you guys had questions in the chat, we will follow up with you after, and we'll go from there. Thank you so much, guys.
Yep. Thank you.
Thank you all.
Have a good night.
Bye.